Welcome to Uncensored Conservatism. This is episode 171, continuing to look at Project 2025. Chapter 24 of 30 is about the Federal Reserve and was authored by Paul Winfrey, who served in the first Trump administration. Now, money is the essential unit of measure and the basis of a market economy. The Federal Reserve was created in 1913 when most workers were agricultural ones. It was formed in reaction to a series of financial crises caused by irresponsible banks that overextended credit. Unfortunately, there is the unintended effect of the Federal Reserve. The government can abuse their authority for their own agendas. Their mandate is to maintain stable prices. In effect, the Federal Reserve is truly independent when economic times are good. Also, mission creep like so-called ESG efforts are a political consideration, not an economic one. The Federal Reserve was created to furnish an elastic currency so that credit could be available along with the increased demand for money. Macroeconomic stability was mandated in the 1970s in response to going off of the gold standard. The Fed is now responsible for maintaining full employment, stable prices, which boils down to inflation, and long-term interest rates. Instead, the Fed should protect the value of the dollar and focus on inflation. As we learned from the COVID-19 pandemic, the Paycheck Protection Program helped businesses better than near zero interest rates. Those lower interest rates benefited the real estate market. That's why homes are so expensive today. And we have a housing crisis. The Federal Reserve should not be the lender of last resort, since this encourages banks to overlend in many cases and feeds bubbles, as in housing. The policy of lender of last resort is simply a taxpayer bailout for irresponsible lending practices. The Federal Reserve now owns $5.5 trillion of the public debt and $2.6 trillion in mortgage-backed securities. This favors reckless government spending and supports politically favored markets like housing and even corporate debt. The Fed's balance sheet should be wound down to 2008 levels, and any increase in the future possibly approved by these guys, Congress. In fact, no more engagement in mortgage-backed securities, and get out of the corporate and municipal debt markets. The goal is to create a climate that provides markets with liquidity without the misallocation of resources. As it stands now, it's not liquidity but credit allocation. The Fed's involvement in the mortgage-backed securities market is a lesson on what they should not do. From 2020 to 2022, home prices increased a staggering 42% and are now 5% higher than their previous record high in 2006. In that time period, the Fed has purchased $1.3 trillion in these securities while lowering interest rates. And what happened in 2008? That's right, it was a financial crisis. Today, the Fed prints money, then borrows it back from banks rather than those banks lending it out. This favors a transfer to Wall Street bankers at the expense of the taxpayer. As far as printing money, the Fed comes under political pressure to do so to fund federal deficits and respond to economic downturns. An option noted is free banking, where the government does not control the money supply or interest rates. The Fed would be abolished and the Treasury would handle the government's money. Now, we actually did this between 1824 to the 1850s, and there was low inflation and vibrant lending. Competition between banks kept them from overlending or overprinting their money. There is also the advantage of fewer cycles of boom and bust. Of course, we could always go back to the gold standard, which is simply backing the value of the dollar by a commodity. I believe spending was originally considered, or the value of the dollar was considered during the Constitutional Convention. James Madison wanted to use wheat. But anyway, this guy, Milton Friedman, proposed the K% rule in the 1960s, where the Fed would create money at a set percentage set by law. Now, under inflation targeting, the Fed establishes an inflation rate they believe the public will accept and then tailor monetary policy around that target. It's generally accepted at 2%, but now some say it should be 3 to 4%, and that would be more realistic. Unfortunately, this would create boom and bust cycles of inflation and then political pressure to address it. So a question needs to be resolved: full employment or price stability, which is basically inflation. Project 2025 argues the Fed should abandon the full employment mandate. So have the Fed publicly announce their targeted inflation rate and a detailed plan to not exceed it with no changes after the fact. Further, Project 2025 comes down hard against any central bank digital currency scheme. And finally, it should be noted that Project 2025 realizes the Federal Reserve is probably not going anywhere, and surprisingly does not call for an audit of the Federal Reserve, which likely is a letdown for this guy. And that's it. Have a great day and a more pleasant tomorrow.